Welcome back, everybody, to the Informed Homebuyer Podcast. I'm Rich Curtis, your local realtor, and I've got with me Dave Miller, our lender here. Welcome back, Dave.
Hi, Rich. Thanks for having me.
Yeah, we just survived the Thanksgiving holiday. I got through pretty unscathed with no big family meltdowns or fights. How'd you do?
I did the same. It was a low, small family event, so it was a lot of personal time. So it was good.
Yeah, that's awesome. I hope all of you, our viewers and listeners, got through unscathed and had a lovely family holiday. Today, we are talking about FHA loans, Federal Housing Administration loans, what you need to do to qualify for one, who they're good for, what they do best, and what are the advantages and disadvantages versus some of the other loan products out there, so you can decide if an FHA loan is potentially the right option for you. As always, you don't have to keep track of the nuts and bolts and every single detail. When you're ready, you can reach out to Dave and I or your trusted professionals in your market if you're not near us, and they can walk you through this process. The purpose of this video is just to give you an introduction so you know whether when you contact your lender, you want to say, hey, I'd like to look into an FHA loan. I think that might be good for me. So we're going to go through it with you now, starting with a brief history. The FHA is a pretty old government institution. It was invented by FDR out of the New Deal in around 1934, after the great financial crisis. And it was basically invented to stabilize the housing market and provide more loan access to more people and spur a larger boom of homeownership, help people get back on their feet, and give mortgage lenders security that if the buyers did default, the government had their back and would make them whole on the loan so that they felt comfortable making more loans to more buyers. So it is traditionally thought of as a first-time home buyer loan because that's what it was intended to do, help people get into their first home. But these days, it's used by all kind of buyers across the spectrum, and we'll talk about that. Now, from the lending perspective, Dave is going to walk us through the benefits of this thing and what you need to do to qualify for an FHA loan in 2024. All right, Dave, you can take it away.
Yeah, thanks, Rich. And I think you nailed it, and why the loan was created. And I've been doing this for over 20 years, and every once in a while I get a potential home buyer coming to me and saying, yeah, I want to see what my rate is, and I'm looking to get an FHA loan. And so they've already made the determination that they want to get an FHA loan. Either they've heard it from someone, a family member, or they've done some research on the internet. Typically, those folks are folks with lower credit scores or folks that have some blemishes on their credit. So when I'm taking a loan application or just pre-qualifying a buyer just based on general conversation dialogue, one of the things I try to never do is instantly determine what type of loan program a buyer should fit into.
Right.
My goal is always put them in the best program for them. After gathering a lot of information. So as I go through the process, I start ruling out some programs and then open and expanding to other programs. So from an FHA loan perspective, they allow for lower credit scores. You could look, some FHA technically allows loans as low as 500 credit score. Probably not going to qualify for that. Once you're under 580, there's going to be some circumstances that FHA, even though they say they will qualify you for a 500 credit score, there's probably some things that are going to preclude you from approving for that loan. And on top of that, you need a lender that's willing to extend credit on a 500 credit score loan. So, really the kind of target is if you're 580 or above, pricing won't be as attractive. Usually when you get to 600, 620, those are the folks that, we're going to look at as FHA before conventional. Now, that does not mean that if you have a 680 credit score that an FHA loan is not right for you. So there's some pros and cons to FHA loans.
And so when it comes to that credit score piece, if you're a 500 credit score borrower or buyer, and sometimes you'll see some sort of inducement or teaser advertising from a lender that says, we do low credit scores. Really what's happening is they're trying to get you into their system, start the conversation, and then start the process of credit repair with you to get you up to the point where you're going to qualify for better pricing And when we say pricing, that's the cost of getting the loan to you. That's the interest rate you're going to get. All of those things go up when you have a worse credit score. So even when you see someone saying, yeah, come on over with a 500 credit score, that probably, most likely, almost in all cases, doesn't mean we're giving you a loan today. It means we're going to help you get there. And I think sometimes that advertising isn't very transparent. So if you come to us with a low credit score like that, it's likely today is not the day we're getting you a loan, but we can put you on the path to a higher credit score to qualify for the best pricing for the program that works for you.
Yeah, and you bring up a really good point, Rich. When we're talking to prospective borrowers and looking, so their situations are always going to be unique to each borrower. What's your timeline? When do you need to buy a home? Or, lease situation? Based on your job situation, there's, everyone's got their own circumstances that are motivating them of, is the time right for them to buy a house? Through that, we look at always is the credit score. And if a credit score is below 740, 720, I'm always going to say, okay, well, what's keeping this score from being at the next level? Because there are incremental benefits and pricing benefits to having as high a score as possible. And so if we're in a short window timeline, 30, 60 days, if you're a 675 borrower or credit score, I could probably recommend some things that'll get you to 680 in that window. Now, if your window's longer and you're just now saying, hey, I'm starting this process, I'm in a lease for the next 6 months, and I'm way ahead of the game, instead of someone calling Rich and saying, hey, I want to, go look at a house yesterday, right? Like you're kind of preparing for it. Those are the types of folks that we could say, okay, well, realistically, where can we get you in that timeline? And will that change your loan program? Or will you still be in an FHA? But always, we will recommend the exercises that you should do to improve your credit score, because ultimately that will help your interest rate.
Yeah, and we have a whole podcast episode on improving your credit score and what we can do to help you and what you can do to help you. I'll put a link at the end to that. So although 500 is the technical minimum, Dave, when you're working with a borrower, what is the minimum credit score that gets them reasonable pricing on an FHA loan?
Reasonable pricing is going to start at 600.
Perfect.
And then 620, and it's always in 20-point increments. So, it's 600, 620, 640. And so that's why I was saying, when I'm looking at someone and they're just a few points below that, oftentimes we can make some recommendations to get them there. So the biggest factor, so FHA versus conventional, and Rich, we talked about this as years ago, conventional, you had to do 5 or 10% down. Now you can get away with 3% down on a conventional loan. And FHA is 3.5% down. So there's a little bit more down. The biggest kicker and benefit for FHA versus conventional is they will allow for the lower credit score as well as higher debt to income ratio qualifications. But those debt to income ratio and the credit score, where conventional becomes unfavorable versus FHA, is the mortgage insurance. So it's called PMI for a conventional loan, private mortgage insurance, and it's called MIP on a FHA loan. Don't expect anyone to remember that, but it's a mortgage insurance premium. And there's two factors with FHA versus conventional. FHA, the mortgage insurance premium, there's an upfront mortgage insurance premium of 1.75% of the loan amount. So,
and by upfront, that is a fee the buyer is paying 1.75% of the loan amount as part of their closing costs upfront for the privilege of getting the loan and insuring the loan.
That is correct. And that there's two ways that you can pay that upfront. You could build it into the loan. So you're basically, and I wrote an example here, I want to say a $500,000 loan has a 8750 MIP, which seems like a lot of money on a $500,000 house. But if that's what it takes to get you in, and you can put less money down, but you typically will have a lower interest rate than conventional if your credit score is below 700. And then we're looking at the debt to income ratio, is where the mortgage insurance, private mortgage insurance on a conventional loan, gets super expensive. So the one thing with FHA is if you put 3.5% down, you're at a 0.55 annual MIP, divided by 12 months, which is relatively low. And that doesn't matter if you have a 600 credit score or a 740 credit score, that stays the same. With conventional and the PMI, I've seen if you're putting 5% down, you have a 680 credit score, and your debt to income ratio is 47, that is going to be sometimes double the mortgage insurance.
And what are we talking dollars, monthly dollars on mortgage insurance?
I want to say on that 500,000 scenario around like $225 in mortgage insurance, which
on FHA or conventional?
FHA.
And so conventional could be up to 500 for the same borrower.
Yes. And it just depends on that debt to income ratio, money down, and FHA, like 3% versus 5% will be significant on conventional, that PMI. So
yeah,
those are all the things that we look at and figure, okay, what's the short-term and the long-term benefit for the borrower? Now, where we get into is that mortgage insurance for FHA, if you're putting 3.5% down, is for the lifetime of the loan.
Yeah, now, you cannot make it go away.
Cannot make
without
it go
a refinance.
Away. That is correct. Now, there is one exception to that, and sometimes this may benefit a borrower if you're looking at putting, say, 10% down, and you're deciding between conventional and FHA. If you put 10% down on FHA, you have an 11-year mortgage insurance premium term. So after 11 years, that will fall off. Most people, I've been doing this a long time, most people do not have their loans that long. Even
with the lock-in effect, and that's out the window. If you're initiating a new loan with us now, where you're going to be in the 6s and 7s, you're going to want to refi. But the pandemic era loan people are keeping those loans longer.
100%.
So some of them might actually trigger that.
Right. So if you did a loan, 2-3 years ago, and you did an FHA loan at 3%, and you put 10, 15, 20% down, you're just going to ride that out and wait for the MI to fall off because it's relatively cheap compared
to you have to sell.
Higher interest rates. So,
all right, so this gets really confusing. Let's break this down. So the benefits we're talking about for the FHA loan, one of the benefits used to be that you could do 3.5% down, and there wasn't really another program outside of like the VA or USDA loans where you could put that much or less down. Conventional loans didn't used to allow you to put that little down. So that used to be an FHA benefit. That's really not a benefit anymore now that 3% is available. You can actually put less down on a conventional loan potentially. So the lack of down payment or the lower down payment isn't the primary benefit here. The primary benefit here is access to the loan at lower credit scores, higher debt to income ratios, and taking a smaller hit on the cost if you have one or both of those two scenarios versus a conventional loan.
Yes. And Rich, bringing up a really good point. FHA loans have changed a lot over the years. And so if you're talking to someone, a friend, family member that got an FHA loan 5 years ago, 10 years ago, or maybe when they bought a house, 15, 20 years ago, it used to be that you used to be able to get rid of the mortgage insurance on an FHA loan. Until recently, the mortgage insurance, the monthly MIP or the annual MIP was much higher even a couple of years ago. That was at, for 3.5% down was at 0.85. And then if you put 5% down, it was at 0.8. They've lowered that all the way down from, 0.55 for 3.5% down, or 0.5 on the annual MIP. So they've dropped that almost in half. Really?
Yeah, because they can make it up by getting it for more years. Yeah,
that is correct. And to open the doors for more, low to moderate income buyers or folks
bringing that payment down.
Yeah. And keep in mind, when we say low to moderate income buyer, it's really for the market that we're in and where you're at in your employment status, income status. Doesn't mean that you're going to be that way forever. We've had plenty of folks that are, teachers or whatnot that start out and they know their salary is going to increase or
every
maybe
year.
double. Yeah. And so the barrier of entry, you might need to do an FHA loan to get in today versus waiting. And I know that's a separate podcast, but what happens if you wait a year or two until you qualify for conventional and can, put more money down? What's the trade-off there?
Yeah. In fact, the first loan, my wife and I, our first loan for our first house was a STRS loan, a teacher focused loan that gave us access to lower down payment initially because it was baked in the assumption that her income just goes up every year as a teacher. So that's traditionally, people kind of forget to take that into consideration if they're in a really, we talk about teachers, you're in a stable career path where you have tenure and your income goes up every year. That's a real strong position to, make a financial decision from, versus if you and I, who are commission only, or earners,
Right. Yeah.
it's a whole different calculus. But so we've established that even though 500 credit score is the low, you need a minimum of 600. When you look at two borrowers just based on credit score, and I know you would never make the decision based on credit score alone. There's a lot of decisions you're making, but what are some sort of cutoffs where, at this credit score, you're going to be better off in conventional, at this credit score or below, you're going to be better off in FHA?
Yeah, I think the biggest factor, usually 680 is that kind of line that I'm paying attention to.
Okay.
Because when you're putting, well, let me back up. If you're putting 20% down, almost always it's going to be conventional.
Correct. Yeah.
But
Because of the PMI.
because of the PMI, if you qualify, then if you're putting less down, it's really going to be your, how much what's the down payment percentage? And usually that's going to be low, 3.5% to 5%. But I'm looking at that credit score and then your debt to income ratio, because the debt to income ratio is going to be that biggest kicker once you're below 680, and even above 680 to 700. The debt to income ratio is going to be the biggest kicker on how expensive your mortgage insurance is going to be. But that's a conversation we have to say, okay, your mortgage insurance is going to be $30 more a month, conventional versus FHA or whatever that's going to be. But you can get rid of this after a set amount of time, and some factors have to take place. That's for a separate podcast. But that mortgage insurance can go away. So those are the things we look at, pay it now or pay it later type deal.
Yeah. So between 600 and 680, depending on debt to income, you're kind of thinking FHA is probably going to be better for people. And 680 or above, you're leaning more towards conventional, just as a general rule.
Just as a general rule, correct.
Yeah. And 20%. Oh, yeah, go ahead.
Yep. Yeah, I said yes, as a general rule, but every unique borrower, we look at everything and say what's the best for you. Yeah.
And then the 20% mark is important because that's where you don't have to pay private mortgage insurance on a conventional loan product. So if you're putting 20% or more down, the private mortgage insurance cost is off the table, versus with FHA. Every FHA loan has private mortgage insurance. And if you're less than 10% down, there's no way to get rid of it for the life that you carry the loan. So once you hit the 20% mark, we're almost always looking conventional for all buyers, unless there's some kind of major credit issue or the way they pay themselves or income issues that we have to get more creative with.
Yep.
Is that fair to say, Dave?
That's very fair to say. The other piece to that is some folks may have less than 20% down, and on conventional, we could look to do what's called a piggyback loan, where you do a small second. So the first loan is below 80%. The risk there is we've seen interest rates go up exponentially over the last, several years. So that your fixed rate portion loan is fixed in, it doesn't change, but typically that second, if it's what's called a HELOC, home equity line of credit, that could go really high and you run some risk by doing that, with that payment going up on that second loan, if you're trying to avoid mortgage insurance. So sometimes mortgage insurance is a fixed known number. Hey, let's just pay that and deal with it.
Yeah. And those are things that are kind of market specific. There was a time where the interest rates were really stable and really low, and taking out a second that was a variable rate might not have been much of a risk. We're in a totally different environment now, where taking out a second loan that's or any loan that is a variable interest rate would be a fairly significant risk right now with interest rate volatility and economic volatility at the moment. Yeah. So, all right. So what we've got is, all right, between 600 and 680, we're generally looking FHA. Above 680, we're generally looking conventional. 20% or above, we're generally looking conventional. Below 20%, then we're weighing the options between conventional and FHA, again, based on that credit score.
Yeah.
And then the debt to income. So these are our three things: your credit score, your amount down, and your debt to income ratio. So let's define debt to income ratio for our listeners, and let's talk about the difference between debt to income requirements on an FHA versus a conventional.
Yeah, good question, Rich, or good point. So debt to income ratio, what lenders are looking at, there's two numbers that we're looking at. Your front end number is going to be your housing expense to your income. And then the second, or what we call the bottom number, is your housing expense plus any additional debt you have. And when we talk about debt, we're not talking cell phone payments, utilities. We're talking things that show up on your credit report, such as installment loans, student loans, auto leases, credit card debt, what your minimum monthly is. And that brings up another factor also when determining your qualification for FHA loans is your additional debt. So once you get below, your total housing expense, typically conventional, they want to see, and there's two different types of underwriting guidelines. There's just traditional manual underwrite, and there's automated underwriting guidelines. Automated underwriting guidelines almost always take higher ratios. But if you have lower, there's certain factors that kick you into what's called a manual underwrite. So we try to avoid that if we can, because they're going to have much lower ratios, where if all these things hold true on an automated underwrite, you're going to qualify for more. And so on an FHA loan, we've seen bottom ratio, your total housing expense plus your other debt go as high as 55%, for example, in some cases. Now, what are the factors on that? And as a lender, as a realtor, we don't ever want to put anyone in harm's way. So we'll look at something that says, okay, well, your debt to income ratio is 55%. That's really stretching you, but that may be a situation where you got 1 year left on an auto loan. And then you're going to own that car, and that's a $750 payment that's going to free up. So does that mean you have to suck it up for a year and you can do that? Or at 55% today, but you're going to get a 5% or 10% pay increase in the next 3 to 6 months. So those are always things that would promote folks to make a decision to make things a little tighter now, knowing that that's not going to be a perpetual stretch.
Yeah, versus the opposite. If you are in year 3 of your student loans and those aren't going away anytime soon, or you just bought that new car and you're on a 6, or I think now they're even giving people like 7-year, because cars are so expensive, then you might be saying, well, you need to do some work before getting into this at this high of a ratio.
Yes.
But that's so FHA, you're seeing as high as 54, 55% acceptable bottom ratio. How's that different from a conventional loan?
On a conventional loan, I've seen 50% bottom ratio. I've yet to see it go above 50%. And if it's 50% on the bottom ratio, they want to see that top ratio, your housing expense much lower, that says, hey, you got a bunch of other debt that potentially can go away. So we're looking at your housing expense ratio. And typically automated, you're going to want to see that under 43. I've seen it go as high as 47. But there's always those other factors, higher credit score are going to allow for, and months of reserve in the bank as well, in terms of, payment, if it's 1, 3, 6 months of reserves, that's going to determine how high your ratios are going to be.
And if you've been watching a while, you know what reserves are. If you haven't been, if this is your first time with us, reserves are just an amount of money in the bank to make sure you're not tapped out, zero balance on day one when you purchase a home. So when we talk about months of reserve, it's months of mortgage payment in the bank. So how many months of mortgage payment you have in the bank can qualify you at a higher debt to income ratio, because the bank knows you can ride out a couple of bad months because you have some money in the bank to still make the payment.
Yeah. One other benefit on the FHA is how they look at student loans is a little more favorable than conventional as well. So a lot of times folks will have, a lot of folks, when you're looking at credit, you have a lot of student loan debt, maybe it's in deferment and there's no payment associated with it yet. So this used to be a really complicated thing, 10 years ago, to really get documentation to prove what your payment's going to be. That's changed. And now on a conventional, they're going to take 1% of your student loan balance and hit you with that, versus FHA is going to take 0.5%. And if you have a lot of student loans,
that's a big difference.
100,000 in student loan debt could be the difference between $1,000 a month or $500 a month. And that could be the difference in qualifying. And we've seen that. So those are all the things when we're looking at your profiles, an individual user's profile, which one, you may not even qualify conventional because of that student loan debt. Then we kick you over to FHA.
So if you're listening to this and you're thinking, am I the kind of borrower or buyer that should consider an FHA loan? Well, if your credit score is under 680, at least talk to your lender about an FHA loan. If your down payment is less than 20%, talk to your lender about an FHA loan. That doesn't mean it is the right option for you. It means it should be one of the options on the table to consider. And if your debt to income ratios are potentially high, and you can just calculate that easily on your own, right? The percentage of your your monthly debt payments overall compared to, what your income is. If that's coming up in the 50% or more range, FHA should be an option that's on the table. Because even though conventional, it would tell me if I'm wrong on this, Dave, but
Yep.
even though conventional, we have gone to 50%. We've had some borrowers qualify for 50% if they have really good credit scores or lots of reserves. The bread and butter really on conventional is around that sort of 48% bottom ratio mark for most people, right?
Yeah, correct. And below that, that is correct.
Yeah. So
Yeah.
50% is possible, but
Yeah.
stretching it, and there has to be mitigating factors for that.
Yeah. The other thing
Yeah.
that comes up, Rich, and this is going to be more in your area of expertise, is when I'm talking to a buyer and we're looking at FHA loan and the market we're in, right? The market we're in at that time, the area that they're looking to buy, and for where you've seen houses from multi-million-dollar houses to really low end, low dollar amount houses that are out in the sticks that would qualify for conventional loan but probably wouldn't qualify for FHA loan. So there's different factors that come into play. FHA's got more stringent appraisal guidelines.
So let's jump into that. But as a bracket for that, for people, loan limit. Is there a difference in the loan limit on FHA or conventional?
Really good question, Rich. And they're not that different right now. So FHA right now, single family, 760 in the areas that we work. Now, keep in mind, if you're considering an FHA loan, there's a lookup tool on the FHA website. You can Google it and and it's county based.
So we'll put a link to that in the description for you.
Yep. And so you want to really find out before what county you're in. Where we spend most of our time working, Rich, 763,600 is that FHA loan limit versus conventional, which right now is 766,550. Now, when we talk about loan limit, that's not what you can purchase. It's after down payment. It's the loan. So I think that's about a 700. If you're going FHA and you're only putting 3.5% down, that puts you about a 790 purchase price.
Yeah. Conventional, just a titch higher.
That is correct. So, and I haven't seen the new loan limits for 2025 for FHA. For conventional, they're going to go to 806,500 for our area. So we're definitely getting up there in loan limits, but those are, and you could be one county over and your FHA loan limit can be significantly different. So those are really important. If you're out shopping for a house and you get pre-qualified for an FHA loan, but you're not county dependent, you're looking at different places. And I've seen that happen in plenty of places in California as well, where you could be 5 miles over, but it's a different county and you qualify for, $50,000 less loan. So pay attention.
Yeah, 100%. Because a lot of our channel viewers, a lot of people who relocate to El Dorado County are coming from the San Francisco Bay Area, or they're coming from LA area, where you're median home prices here in Sacramento area, $516,000, Placerville, $505,000. In the San Francisco Bay Area, you're talking 1.4 to 1.7 million. In the LA area, you're talking about 1.4 million. So the conforming loan limits there, the upper limits are going to be higher. So if you've gone and talked to a lender because you were looking at buying in your local area and what you could get, and then you decide maybe I want to move up here, those limits, you're going to be able to get less loan, basically, in those different areas. So there's something to consider. It's why you always want to try to talk to and work with a local lender to the area you're heading to. But let's talk about the difference in how sellers perceive your FHA loan and in the appraisal process. And those two things are linked. The seller's perception is kind of based on the sort of an older or antiquated view of the appraisal process with FHA. So, one of the things that's powerful when you work with a realtor who's not just a buyer's agent, but that does listings and buyers, is they know what the people on the other side of the table are thinking, right? So I do both listings and buyers. When I'm on the listing side of the table, our traditional, I've been doing this 20 years. So our traditional hierarchy is give me a cash offer. That's great, because now there's nothing that can go sideways with the loan. After cash offer, give me a conventional offer, because formerly conventional loans didn't allow you to get down into the 3% range. So a conventional buyer was going to be putting, I mean, way back in the day, 10% or more down, and now they can go as low as 3%, but a conventional loan was an indication of a stronger buyer, a buyer in a stronger financial position. That one's not really true anymore now that you can actually put a little bit less down on a conventional even than on an FHA loan. Although those credit requirements and debt to income requirements still signal to a listing agent that an FHA buyer is a slightly less financially strong borrower. So we're looking cash, conventional, FHA. Then it used to be, VA, and then USDA and all the others sort of down the bottom. And that was because VA and FHA both had really in the past contentious appraisal processes where the appraisers for those loans would look harder literally than an appraiser for a conventional, and they would call things out. And now the seller's in a position, if they wanted to close a loan and sell to that borrower, they have to make those repairs. Doesn't mean they have to be the one to pay for them. That part was negotiable, but usually with a borrower that had less money, they didn't have any gas in the tank to make the repairs anyway. So when a seller accepted an FHA loan, they knew someone was going to look a little harder at their house, probably call some things out that they were going to have to pay for on behalf of this buyer to make the deal happen. So if they could get a conventional loan that was going to have a less strident appraisal process, less chance of call outs and necessary repairs they have to make, they're going to go that route, which is what put FHA loans in that sort of third tier of preference for sellers. Now, in my opinion, now I'm just looking at the overall financial strength of the borrower when comparing these two loans. The FHA appraisal process is, essential. I'm sure there are some nuances for the appraisers themselves, but from our experience of it on the real estate side of things, it just is about the same. I don't experience contentious FHA appraisals anymore, or even I couldn't even remember or tell you the last time I had an FHA repair call out, or
Yeah.
I don't know if that's the same for you, because you'll find out about the call outs too. It'll come across your desk.
Sure. And usually there's a conversation between realtors, agents, listing agents, buyers agents about, hey, this is an FHA loan. Here's a couple things that you want to make sure you're prepared for. So an appraiser doesn't need to come back. And that holds true with conventional now too. There's things that, a CO2 detector and double strapped water heaters, right? Like there's things as agents, you'll just, on a walkthrough. Now, the difference too is, Rich, we've been doing this a long time. We see the market change a lot since the Great Recession. And after, there was a lot of REOs and bank, foreclosed properties where they may but, for an FHA appraisal, you need the gas on, they're going to turn on the water. A conventional appraiser is not going to do those types of things. FHA appraiser is supposed to poke their head in the attic, take a look around. They're not going to crawl in it, but they'll poke, and make sure the heating system works. They'll turn it on, make sure it fires on. So those are things that you would know as a buyer's agent and as a listing agent, and oftentimes your home inspection's done before the FHA appraiser even goes out there. So if there's something that's not working, you're going to address that with the seller right away.
Yeah. And usually even up front, we've talked about this. I think if you watched our inspections podcast, after doing this for 20 years, I'm giving you half of a home inspection as we walk through the house together on our first visit. I'm telling you the things I see. If the roof's looking bad or hinky, I'm telling you that. If I see things that an appraiser will call out, I'm going to tell you that too. There were the sort of nuances with the FHA, like no peeling paint, and you have to have all the floor coverings in and things like that. But the truth is, a conventional appraiser is probably going to hit you if you've got carpet that's torn up anyway. If there's an obvious deficit or problem that affects the value of a property, no lender wants to buy that problem. So usually if I'm on the listing side up front, I'm telling my sellers, here's some things you just have to fix before we put this on market. So you have the full breadth of buyers available to you. If you leave this problem that's going to be an issue for an FHA loan, we just lost a whole segment of the buyer pool for this property. And if it's a $1.5 million property, maybe you're not worried about losing the FHA buyer segment. But for the most part, all of our bread and butter regular home clients, you're going to want to cure anything that's going to be an impediment for any kind of a loan program. And similarly, if the buyer's home of choice and we're walking through it and I'm representing the buyer, if there's some problems that are going to stick out, for an FHA loan, I'm going to tell them that up front. This might not go. So we're going to have to ask in our offer for the seller to repair. We're going to have a conversation with the agent. Is your seller willing to repair this, this, and this that I know is going to scuttle this loan that we have to have in place and repaired to make the property safe and sound when an appraiser comes out? Things like rotted decks are a big deal for any loan, right? We've talked about that before.
Yes.
Sometimes sketchy hand railings on decks. We see that all the time, or sketchy staircases on decks.
Yeah.
So these are things that we're going to get out ahead of. So by and large, from a seller's perspective, whether it's conventional or FHA anymore doesn't really matter to me. What the buyer is putting down matters, So if I have a conventional loan, I have two offers on property, a conventional and an FHA, and FHA is putting down 3.5, and the conventional is putting down 3. Well, those are essentially the same strength buyer to me, right? So then we call the lender and we have a conversation with the lender about the strength of the buyers, ask more questions about their employment status and everything else. So we're really digging in as a listing agent to the actual strength and financial position of that buyer more now. The actual program they're in isn't as strong an indicator of their financial strength as it once was. And so the stigma to an FHA loan and all the pain points of an FHA loan have really, by and large, gone away. So in my opinion, there's no reason not to pursue an FHA loan if it's the best loan for you.
Yeah. And I think, Rich, that brings up another question for you as the listing agent. And you brought up, value wise, if you are listing a house and you feel confident in the comps and you're pricing it correctly, an FHA loan, a buyer's offering $10,000 more on an FHA loan than a conventional buyer that's putting 20% down, right?
Yeah.
Like if you feel confident it's going to praise out, your seller's going to net $10,000 more going the FHA route. It's the same, right?
Why not? Let's do it. Yeah.
Yes. Okay. Yeah, I just want to make sure, so when you got, a lot more money down, that really benefit to the seller. It's just you could make up if there's a shortage on the appraised value, right? Like that's the, I would say the biggest kicker there.
Yeah. And that is market specific. So if we were doing this podcast in 2021, where the world was insane and where I'm getting no less than 20 offers on every listing I have, and sometimes over 100, I think we had one in Citrus Heights that got like 1,500 offers on one home in Citrus Heights at the height of the insanity. Well, in that environment, FHA is putting you in the third position because there's the seller is spoiled for choice at that point, right? Like there's no way that in these 20 offers that I have, all 20 are going to be FHA. I'm going to at least have one conventional in the mix. So that's the situation where when a listing agent, I think people think that those kind of markets are like, realtors love them and sellers love them. This is amazing. No, the truth is I'm probably going to get you the same price for your property with 5 offers as I am with 20 offers. The 20 is just way more stress and way more work. And we have to find a way to quickly start to slice some of those offers off the table so the sellers can make an informed decision about the best ones. And so really quickly, if I'm submitting offers in 2021 on a house that's got 40 offers, I know my FHA loan goes right in the we're not even going to look at it bin. Because out of those 20 offers, I got 5 conventional and 3 cash, right? And truth of the matter is if the cash ones are decent prices, all the conventional ones went right into the bin as well. And now we're only going to counter the cash people. So there is a market component to this, but in the market we're in now, which is still a slight advantage to sellers market, but very quickly approaching a neutral market, essentially no real competitive advantage to a conventional over an FHA, in my opinion.
Right. And I also think, Rich, and not to pat you on the back too much, if you're working with a buyer's agent and you are submitting a FHA loan, and Rich, you're the buyer's agent, you're going to express some expertise to the listing agent that you're aware my buyer's doing an FHA loan. Here's all the things I'm aware of. And you can put them at ease by like letting them know you've already paid attention to all the things that would typically preclude an FHA loan from going through. So,
or cause a problem.
Or cause a problem. So I think that goes a long ways when just you're showing your knowledge and paying attention to the things that, and that's just based on years in the business and looking at every different type of house that there is out there.
So. Yeah. And I think a future podcast would be great. We can kind of go over sort of a full offer process and the things we can do to give you a real leg up in that. And so what Dave's referring to now is I never submit an offer blind, and it is staggering to me. And we got a lot of new agents in the business in 2021. A lot of people had left their jobs in 2020 for different pandemic reasons, either forced to, laid off, or just left. and the real estate started to boom. And so a lot of people got real estate licenses. And I see this a lot with new agents, where I just had 2 in Sacramento area, but both in Rosemont, actually, that we worked on, Dave.
Yep.
People just dropped offers in my inbox. Never heard from the agent, didn't know the agent, didn't call me to express the value of their clients, how solid they are, where they're at in the loan qualification process, didn't call me to go over the nuances of their offer, just blind sent an offer, which already sets you up at a great disadvantage, basically. So the first thing we're going to do, especially if we have an FHA borrower, and especially if it's a competitive market, is call that listing agent and say, yeah, we're FHA, but here's what we're doing. We're coming in above asking. We've already got this person, fully pre-approved property address to be determined. They've already gone through underwriting. We've vetted all the problems. I've walked through your property. Your sellers have done a great job keeping that property in good condition. There's not going to be any call outs on the appraisal. And by the way, you're going to hear from my lender, Dave Miller. He's also going to give you a call and walk you through how qualified these buyers are. So by the time they review our offer, they've had a conversation with me. They've had a conversation with Dave. And again, not all of you are in our market. If you're watching from Texas, I'm not going to help you buy your home. If you want help finding a qualified agent, we can do that for you. But you've got a trusted agent and team in your area. Just make sure they're doing these things for you. Because there are some older realtors who've been doing it a long time who still are probably carrying a little bit of that stigma about an FHA loan. And it's your job, the representation you're paying for, is to call that person and make sure they know your FHA loan's not an issue on the buyer side.
Yep.
So, all right. I think we've pretty well gone through FHA. Just to do a recap, you're probably going to want to be 600 above on credit score before you really pull the trigger on any loan product, really. And if you're below that, check out our podcast episode on credit and on qualifying for a loan, and reach out to us if you're in our market, or to a local lender that you trust in your market to help you with that credit fixing process. But you're looking at 600 to above, and you're probably looking 600 to 680 is the zone in which you're considering an FHA loan. You're looking at your debt to income ratio being, probably 50% or above to make FHA really something that is a strong consideration, possibly the best program for you. And 50% or below, conventional may be a stronger option at that point. You're looking at below a 20% down payment. FHA is on the table as an option. Above a 20% down payment, if you have reasonable debt to income ratios, probably conventional is going to work out better for you. And the 2 loan products, although there is sort of a traditional advantage to a conventional loan from the perspective of the person you're submitting the offer to, the listing agent, really that isn't the case now. And there's a lot we can do to sort of neutralize or negate that sort of hanging on leftover stigma of the loan. So hopefully that gives you guys. Oh yeah, go Dave.
One last point on that, Rich, is we covered a lot of stuff. Rich talked to you about debt to income ratio, credit scores, different thresholds. You don't figure it out on your own. Pick up a phone, 5-minute call. I'll figure it out for you. Probably less than 5 minutes, ask you a series of questions. So don't feel like you need to know all this stuff before you reach out. That's our job. We're here, but we're just giving you some parameters, things that we are paying attention to.
Yeah, and these are not like obligation type conversations. This is you call Dave and said, think about an FHA loan, or here's where I'm at. He's not running your credit and having you sign a contract. He's just having a conversation, giving you some advice, telling you what you need to think about, and then you come back to him or us and say you're ready to pull the trigger and go deeper. But part of what we do as real estate professionals is we provide a free public service. Not everybody's ready today, but call us, get the information, get yourself on track for when you are going to be ready, or to put yourself heading the right direction to be ready. If you contact any real estate professional, whether that be my realtor like myself or a lender like Dave, and they're instantly like, let me pull your credit, let me send you over a contract, let me get you moving down this process today, right this second, that's a good indication you should make a different call. Your first phone call should just be exploratory on both our parts, us trying to get to know what your goals and needs are, and you trying to get the information you need to decide whether this is the right time for you or not. Again, we have videos on the channel, whether 2024 is a good time for you to buy or not. And we'll do another podcast episode on that for you. But wherever you are, if you call a real estate professional and the first thing they do is try to gather a bunch of information rather than ask you personal information, contact information, rather than just ask you some questions and give you some advice, you've already got an indication you've called the wrong person. These are complex situations, and you want someone who's starting to guide you towards the right decisions before initiating any formal processes, if that makes sense. So,
yep.
All right. And anything you've got to add there on FHA and FHA qualification 2024?
Nope. I think that's great, Rich. I think we summarized it. We're 44 minutes in. I think we can keep going, and we're passionate about this, but I think this is a good place to move on to the next one.
Yep. If you've listened to two middle-aged real estate professionals prattle on for 45 minutes, you are either serious about your education and getting the best deal on real estate, or you're a glutton for punishment. I don't know which, but either way, thank you for sticking with us. Thank you for making it to the end. Thanks for watching, and we'll see you on the next one.
Thanks.